In March 2023, Silicon Valley Bank held $209 billion in assets. Within 48 hours, the institution was gone. When rumors of financial stress hit venture capital group chats, depositors panicked. They withdrew $42 billion in a single day, executing the first social media accelerated bank run in history. 5 days later, the panic reached Europe. Credit Suisse, one of the 30 massive institutions deemed globally systemically important, began to buckle. To prevent a worldwide financial meltdown, the Swiss government had to engineer a $3 billion emergency takeover by UBS. Politicians declared the banking crisis over, but the fatal flaw that broke SVB was never actually repaired. During an era of near-zero interest rates, banks took in massive amounts of short-term cash deposits and locked that cash up in long-term government bonds. When interest rates rose rapidly to fight inflation, the value of those bonds collapsed. Fast forward 3 years to 2026. Every one of those underlying pressures has intensified. The unrealized losses sitting on bank balance sheets haven't disappeared. The regulatory loopholes are still open, and the speed at which a digital bank run can drain an institution remains terrifyingly fast. The collapses of 2023 were a live stress test of the global financial system, and the system failed. Those missing billions were the early warning tremors of a much larger economic earthquake that is already building. Today, the United States national debt sits at $36.2 trillion. That equals 119% of the country's entire economic output. We have never seen borrowing on this scale during peacetime. This bar chart breaks down exactly how the U.S. government spends its money. Notice the bar for interest payments. In fiscal year 2025, the cost of simply carrying the national debt hit $1 trillion. That means the government is now spending more money paying off bondholders than it spends on Medicare or on the entire national defense budget. The danger here is a mathematical trap. Higher total debt forces the government to make higher interest payments. Those massive interest payments widen the annual deficit. To cover that deficit, the government has to borrow even more money, which adds directly to the total debt. The cycle feeds on itself, spinning faster every single year. The United States is locked into dedicating a massive, growing percentage of its wealth merely to service the debts of the past. That leaves significantly less fiscal power to invest in infrastructure, respond to emergencies, or build resilience for the future. While the national debt threatens the federal government, a highly localized threat is tearing through smaller U.S. regional banks. The pandemic normalized remote and hybrid work. Consequently, office occupancy in major cities never fully recovered, leaving millions of square feet of commercial space permanently empty and their property values in freefall. In 2026, the financial system hit what is known as the maturity wall. Roughly $2 trillion in commercial real estate debt is coming due. Because the buildings have lost so much value, borrowers cannot secure new loans to pay off the old ones. Their only choices are to refinance at punishingly high interest rates or default entirely. The institutions holding these toxic real estate loans aren't the megabanks. They are smaller, regional banks, the exact same tier of institutions as SVB. Many of them hold commercial real estate debt that equals 500% of their total equity. If commercial borrowers default en masse, these regional banks will be instantly insolvent. An empty downtown office building is a direct hazard to the banking sector. It is the specific catalyst primed to wipe out the equity of America's regional banks. In China, a slow-motion collapse in the property sector has already wiped out major developers. But beneath the official numbers lies a hidden layer of local government debt, trillions of yuan borrowed off the books through regional financing vehicles. As property revenues vanish, this hidden debt directly drags down China's massive state-backed banking system. Meanwhile, Europe is trapped by a structural flaw in its own financial rules. This flow diagram illustrates the sovereign bank doom loop. European banks buy up their own government's bonds, treating them as perfectly safe assets. But if that government struggles to pay its bills, the value of those bonds drops, immediately weakening the banks that hold them. French, German, and Italian banks are heavily exposed to their own national debts. If Italy's persistent fiscal deficit causes its bond values to slip, Italian banks take an immediate hit. To save the banks, the government has to borrow more money to bail them out, which only makes the national debt worse. U.S. regional real estate, China's hidden municipal borrowing, and Europe's doom loop. These are interconnected fault lines waiting to rupture together. In 2026, external macro shocks are actively hitting this fragile system. The war involving Iran oil prices above $100 a barrel. That energy spike creates global inflation, which forces central banks worldwide to keep interest rates punishingly high, exactly when heavily indebted borrowers desperately need cheaper money. Simultaneously, AI job displacement is leaving newly unemployed workers unable to pay their mortgages, while supply chain breakdowns from the Middle East are ruining corporate profit margins. Every disrupted business and every defaulted mortgage ultimately manifests as a toxic asset sitting on a bank's balance sheet. When the banks collapsed in 2008 and again during the pandemic, governments stepped in with multi-trillion-dollar rescue packages. But today, with national debt sitting at 100% of GDP, governments have exhausted their fiscal buffers. They cannot afford to bail out the system again. If policymakers try to use the old playbook, printing and borrowing trillions to stimulate a debt-crushed economy, it could actively backfire. Flooding the market with new money when investors have already lost confidence in sovereign debt is the exact mechanism that triggers hyperinflation. History shows us exactly how fast a society unravels when its government loses the credibility to service its own debt. In Argentina in 2001, bank accounts were frozen and middle-class savings were vaporized overnight. The buffers protecting modern Western economies are massive, but they are not infinite. The solutions to this are well documented. Nonpartisan fiscal watchdogs have published actionable, detailed frameworks to stabilize debt trajectories and fix regulatory gaps. The technical answers exist. What is missing is the political courage in Washington, Brussels, and Beijing to implement them. The global financial system is the plumbing of human civilization. It is the final absorber of every geopolitical conflict, every technological disruption, and every catastrophe on Earth. That plumbing is currently carrying more pressure than it was ever designed to handle, and we are rapidly running out of time to fix it before it shatters entirely.